Hello everybody. I'm going to go straightly to the topic of my first video, which is analyzing the Disciplined Trader book written by Mark Douglas. So here we go. In the stock markets, in the financial markets, it doesn't matter which market we are trying to speak about. It can be the stock market of New York, it can be the forex market or cryptocurrency market, and etc. There is always a very big rule. And you know what that is? I will show you what it is. You see, imagine you earn $500 in a trade, and the other person of other side of the trade, what will happen to him or her? That's the big question that nobody never mention for you, because everyone wants to give you the sweet dreams, success stories for being a good trader. You see, there is always two sides, and you have one of these positions. Literally, you are a buyer or you are a seller, right? So in order to win the trade, as one side of it, the other side must lose. I mean, not should, must lose. You know why? Imagine the trading price is $1,000, okay? So if the price go up 50%, you will gain, your gain will be $500. In that scenario, you as a buyer get this profit, but the seller, which already sold at 1,000, he or she will have the opportunity cost, you know, opportunity cost as much as $500. So now we can understand the mechanism of every trade. It's a two-side, two-way, and always will be like this. And remember, the balance always will be zero. I mean, you get $500. Other person's opportunity cost is exactly $500. And this is the simplified form of trade. If you want to dive into the blockchain technology, one thing that you should know about Segwit, which I'll probably speak in future, is that for example, imagine three sellers with lower power, with lower money, and one buyer equal to them, right? So what will happen in this scenario? When the initial price is $1,000 and the price go up, for example, let's say $120, profit for who? For the buyer. Or let's just reverse the equation this time. We have one seller here which sold the asset in the base price, which is 1,000. So his opportunity cost in this case is 120, right? And we have three buyers totally buying this 1,000, each of which is getting, yes, $40. So the opportunity cost of the seller is exactly equal to the profit of the buyers. So the equation always equals to zero. And that's the fact of every financial market. In any kind of position, in any kind of trading, such as short sell, such as futures with leverage, whatever, perpetual or etc., it is always the case. You know, for example, when you use leverage in the forex market, if you win the trade with the leverage of, let's say, 1,000, then the broker will pay the loss, right? So it is always the same way. And Mr. Douglas mentioned it very correctly. So here we are. If you want to win in the financial markets, you have to understand the basics first. And this is one of the most fundamental and most important things that you should do know about. It's like the Newton law. If the desk is still on the ground, that's because millions and millions of different forces are getting into it. And the result of the forces are zero. And that's the balance of the market. Always will be and always was. Just like this. So the total force is always equals to the zero. And you have to be acting like one of these forces with technical and fundamental analysis to get the profit and to avoid the opportunity cost, which I mentioned earlier. So this is my first video, and based on the impression of the people who will watching it, I will adjust my next ones. Hope you will subscribe to my channel and mention your opinions in the comments in order to smooth up the things. I want my videos to be so much productive and so much good for you. Remember, cryptocurrency will be our next analyzing platform in the page. So be ready for the next one and subscribe in order to be notified when the next one will be uploaded. Wish you all great wealth and health, my friends.